Hey everyone, and welcome to today's Explainer. So, we are tackling a topic today that, let's be honest, usually makes people want to run for the hills. Yep, we're talking about accounting. But do me a favor and completely throw out the idea that this is just a bunch of tedious, mind-numbing math. It's not. It's literally the universal language of business. And the best part? You actually already understand the fundamentals of this intuitively. We just need to give you the proper vocabulary so you can connect the dots.
Let's be real for a second. Are you actually getting ahead financially, or are you slowly falling behind? Have you ever gotten paid on a Friday, and by the following Wednesday, you literally could not tell a single living soul where that money actually went? Or maybe, you earned more this year than last year, but somehow you actually have less saved up. If someone asked you right now whether you're getting ahead or falling behind, and you genuinely don't know the answer, I really want to validate that anxiety for you. It's not because you're fundamentally bad with money, it's simply because nobody ever taught you how to read the system.
And that system has a name. Accounting is the language of business. That's the core thesis of our explainer today. Because at the end of the day, every complex spreadsheet, every incredibly dense financial report, every set of corporate accounts, it's all just a highly structured way of answering three really simple questions. Where does the money come from? Where does it go? And what is actually left over?
So here is our roadmap for today. We're going to cover 1. The language of money. 2. The ultimate accounting equation. 3. Tracking the financial cycle. 4. The 3 key statements. 5. The accrual reality check. And 6. Reading the final score.
All right, let's dive right into Section 1, the language of money.
To make this crystal clear, we're going to map some massive business concepts directly onto your personal life. It all starts with 3 core terms. First up, assets. Basically, these are things you own that hold future value. Your smartphone, your savings account, your car, those are assets. Next, we have liabilities. These are things you owe to other people. Think your rent, student loans, or that credit card balance. And finally, equity. Equity is simply the gap between the two. If you take absolutely everything you own and subtract everything you owe, the value that is genuinely, fully yours, your true net worth, well, that's your equity. Two people can earn the exact same salary, but have completely different equity based entirely on what actually survives the trip to the bottom of their bank account.
Now, it's absolutely crucial to realize that these assets and liabilities are not created equal. We divide them into 2 buckets, current and non-current. Current basically means short-term and urgent. Cash is a current asset because you can go spend it right now. A credit card balance is a current liability because, well, the bill is due this month. Non-current, on the other hand, refers to long-term structural items. Your car is a non-current asset. You can't exactly swipe your car at the grocery store checkout. And a student loan is a non-current liability since it stretches over decades. Mixing up urgent, short-term obligations with long-term structural commitments is a classic mistake that causes so much financial stress. Accounting categorizes them so you know exactly what can break you this month versus what is just a slow, long-term commitment.
Moving right along to Section 2, the ultimate accounting equation.
Now that we have the basic vocabulary down, let's look at the bedrock of global business. Behold, the ultimate accounting equation. Assets equal liabilities plus equity. Seriously, this isn't just a formula. It's a fundamental law of financial physics. Everything a business owns is perfectly equal to what it owes to third parties plus what it owes to the owners. For example, if you have $10,000 in savings and $8,000 in debt, your equity is exactly $2,000. Every single financial statement ever produced by any major corporation on Earth is just a highly detailed, expanded version of this exact simple math.
Because that equation literally must always balance perfectly, we use a system called double-entry bookkeeping. And get this, it was invented by an Italian monk way back in 1494. It has been running the global economy for over 500 years because it just works perfectly. The rule is that every transaction has 2 equal and opposite sides, a source and a destination. We call these credits and debits. Credits, which we track on the right side, represent the sources where economic benefit flows from. Debits, tracked on the left side, are the destinations where that benefit flows to. So if you buy a laptop for $1,000 in cash, your equipment asset goes up by $1,000. That's a debit, the destination of the value. And your cash asset goes down by $1,000. That's a credit, the source of that value. One asset basically trades for another, and the total equation remains perfectly, beautifully balanced.
Okay, Section 3, tracking the financial cycle.
Let's pull this out of the abstract and see how businesses actually track money in motion. Imagine you run a dog gossip tabloid, let's call it Rough Times. You run a big promotion and collect $40,000 in cash for annual subscriptions. Here's the cycle. Step 1. Identify the transaction. Boom, you got 40 grand in cash. Step 2. You create a journal entry. This officially records the event by debiting cash and crediting subscription revenue. Step 3. This data gets posted to the general ledger. Think of the ledger as the central database holding your T accounts. They're quite literally shaped like a T to separate those left side debits from the right side credits. And finally, Step 4. At the end of the year, you run a trial balance. This simply lists all your closing account balances to prove that your total debits perfectly match your total credits. It's essentially a stress test to ensure the whole system is absolutely flawless.
Which brings us to Section 4, the 3 key statements.
All this tracking is great, but what's it actually for? Well, it culminates in reports used by investors and owners to measure the health of a business. The first output is the income statement. You might also know it as a P&L, or profit and loss. It reads sequentially from top to bottom, kind of like your personal pay stub. At the very top is revenue, which is every single dollar customers paid you. Then, you subtract costs in layers. You subtract the cost of actually making the product to get your gross profit. Then you subtract rent and salaries to get your operating profit. And finally, you subtract taxes and interest to arrive at net profit. That is the actual bottom line. As the old business saying goes, revenue is vanity, but profit is sanity. A company can boast massive, record-breaking revenues at the top, but be quietly bleeding to death by the time you reach that net profit at the bottom.
Let's compare the big 3 statements side by side because how they interact is brilliant. Think of the balance sheet as a photograph. It shows exactly what you own and owe at one frozen second in time. It answers, what are we worth today? The income statement, which we just looked at, is more like a video. It plays over a whole year to answer, did we profit? And finally, the cash flow statement is pure reality. It asks, will we actually survive? This distinction is critical. A company can show massive profit on the income statement video, but quietly go bankrupt on the cash flow statement. Why? Because the money they supposedly earned on paper hasn't physically arrived in the bank account yet to pay the actual rent.
Now let me introduce a concept that bridges that gap between paper profit and physical reality: depreciation. Say you buy a laptop for £1,000. By next year, it's only worth £700. You didn't write a physical check for £300, but you did use up £300 of that laptop's value. Accounting spreads the cost of an asset over its useful life. Claiming this £300 loss on paper reduces your reported profit on the income statement, but not a single penny actually leaves your bank account this year. It is a non-cash expense. And the best part, it legally reduces your tax bill. The government is effectively sharing the cost of your assets wearing out. It's a massive advantage, but it goes completely ignored if you don't speak the language.
Next up, Section 5, the accrual reality check.
This leads us seamlessly into the critical difference between the money you claim on paper and the physical reality of your bank account. There are basically 2 ways to play the game. Cash accounting is super simple. You record money only when it physically enters or leaves your bank. So if a freelancer works all of January but gets paid in March, under cash accounting they look totally broke in January and rich in March. Accrual accounting, however, says you recognize revenue when you earn it, regardless of the cash flow. Remember our Rough Times tabloid? They collected $40,000 in cash in March for a whole year of magazines. Well, under accrual rules, they haven't actually earned most of that yet. They have to shift those unearned months into a liability account called deferred revenue because they technically owe their customers magazines. Accrual accounting gives you the most accurate, smoothed-out picture of a company's long-term financial reality.
And speaking of reality, I want to share my absolute favorite metric, the break-even point. Let's say a local coffee shop has £1,500 a month in fixed costs, like rent. After buying the beans and milk, they make £2.20 in gross profit per cup of coffee. If you divide their fixed costs by that gross profit per unit, that's the core formula right there, you get 682. That means this coffee shop must sell exactly 682 cups of coffee before they make a single penny of actual keep-in-your-pocket net profit. Every single sale before cup 682 just pays for their right to exist. Every sale after is pure profit. If you run a business and you don't know this exact number, you are literally flying blind.
Finally, Section 6, reading the final score. We've built the foundation, we know the statements, so let's bring it all together. When evaluating companies, investors use financial ratios as quick shortcuts. A 10% profit margin means 90 cents of every dollar just went to covering costs. A PE, or price-to-earnings ratio, of 25 means investors are willing to pay $25 for every $1 of profit the company earns. But remember, context is everything. A 5% margin is a total disaster for a software company, but a massive triumph for a grocery store.
Now, how do we know we can even trust these numbers? That's what audits are for. External auditors verify that the math matches reality. But a quick word of caution from history. Passing an audit just means the math isn't obviously fabricated. It does not guarantee health. Think about Enron. They passed all their audits with the firm Arthur Andersen, right up until both companies spectacularly collapsed. Auditors provide a layer of trust for sure, but they aren't a flawless guarantee.
And that brings us to the end of our explainer today. Assets, liabilities, equity, cash flow, depreciation. This is the hidden machinery that quite literally runs the world. Every financial headline you read, every stock you evaluate, every decision you make about your own net worth, it all relies on the system you just learned. The numbers were always there, surrounding you every single day, but hopefully that invisible language is now visible. So I'll leave you with this. The next time you look at your own bank account or read about a massive company's success story, can you read what the numbers are really telling you? Keep exploring, keep learning, and use this new language to take control.